Have you ever wondered how money is created? It's a question that many people ask, but few understand. In this video, we'll be diving deep into the world of money creation and explaining how it all works. From the history of money to the modern-day banking system, we'll cover everything you need to know about how money is created. So, get ready to learn. First, let's take a look at the history of money. Before the invention of money, people used a system of bartering to exchange goods and services. However, bartering was inefficient and often led to disagreements over the value of different items. To solve this problem, people began to use precious metals like gold and silver as a form of currency. This eventually led to the creation of paper money, which was backed by the value of the precious metals held in reserve. Now, let's fast forward to the modern-day banking system. Today, most money is created through a process called fractional reserve banking. In the simplest terms, fractional reserve banking is a system where banks keep only a portion of their deposits on hand as reserves and loan out the remaining money to borrowers. This creates new money in the form of credit, which is injected into the economy. The concept of fractional reserve banking is not new, as it dates back centuries. However, the current system that we have today is vastly different from the historical version. Today, money creation is largely electronic, meaning that banks can create new money with the click of a button. This has resulted in a massive increase in the money supply and has played a significant role in the growth of the economy. While fractional reserve banking has been effective in stimulating economic growth, it also has its downsides. One of the biggest concerns is the potential for a bank run, which we mentioned earlier. If depositors lose faith in the bank and withdraw their money en masse, the bank may not be able to meet the demand for cash withdrawals. This can lead to a panic and a domino effect, which can cause multiple banks to fail and lead to an economic crisis. Another downside of fractional reserve banking is the risk of inflation. When banks create new money, it can increase the money supply and lead to higher prices for goods and services. This can be problematic if wages don't keep pace with inflation, which can erode purchasing power and hurt those on fixed incomes. There is also the issue of debt. Fractional reserve banking relies on debt, as banks create new money by lending it out. This means that the economy is built on a foundation of debt, and if too much debt is accumulated, it can lead to a financial crisis. In addition, the interest charged on loans can be a burden for borrowers, especially if they are already struggling to make ends meet. Furthermore, the creation of new money through fractional reserve banking can contribute to economic inequality. As the new money is injected into the economy, it tends to flow to those who are already wealthy, as they have greater access to credit and investment opportunities. This can widen the wealth gap between the rich and the poor, leading to social and political unrest. It's also worth noting that the fractional reserve banking system is not without its critics. Some argue that it is inherently unstable and that it encourages risky lending practices that can lead to financial crises. Others suggest that a different system, such as a full reserve banking system, would be more stable and less prone to economic shocks. Now let's turn our attention to the role of the central bank in money creation. Central banks, such as the Federal Reserve in the United States, play a crucial role in managing the money supply and interest rates. They do this by controlling the amount of money that banks are required to hold in reserve, as well as by buying and selling government bonds in the open market. Central banks also act as lenders of last resort, providing emergency funds to banks in times of crisis. This can help to prevent bank runs and stabilize the financial system. Additionally, central banks often set interest rates, which can have a significant impact on the economy as a whole. By lowering interest rates, central banks can encourage borrowing and investment, which can stimulate economic growth. Conversely, raising interest rates can help to control inflation by reducing the amount of money in circulation. Despite their important role in managing the economy, central banks are not without controversy. Some argue that they have too much power and influence over the financial system, while others criticize their lack of transparency and accountability. Additionally, central banks can be influenced by political pressure, which can lead to decisions that prioritize short-term gains over long-term stability.